Thank you, Emis, and great to see a lot of people here. Thanks. Oh, you're already running my presentation. Some familiar faces, but some new ones as well. So maybe bit of introduction on my side. So as said, Reimo Linnavirta is the name, and currently partner at Trint Ventures. We are an Estonian VC, but always had a heavy presence in Finland as well. So I'm based in our Helsinki office. And we invest all over Europe into companies with what we call a consumer or community component. So typical cases, marketplaces, platforms, also B2B SaaS, but on B2B SaaS is more of a consumerized kind of, so not heavy enterprise sales, but something that the entrepreneur buys with a credit card online. Before joining Trint, I was angel investor, so I realized that I have now over 15 years of startup investing behind me and over a decade as a full-time profession. And I have been training actually on due diligence quite a lot. Part of the reasons that I was too active in FIBAN, so they asked me to train. My first reason to come to Latvia has been to train about how to evaluate startups. But also during my early career, I worked at one of the big fours at EY. And that there was more on the private equity deals, so I actually participated in over 300 due diligences. So I've looked on all of the stages from the very early angel stage to the VC growth stage, all the way when you exit to the private equity or go to the IPO. And the thing is that we talk about due diligence, but it's very different actually on different stages. But yeah, today's idea is that we dive a bit deeper into that one, and always hope to have a good discussion. So whenever there's a questions, we have a time for questions at the end. But if there is something, just raise hands, shout it out. Happy to have a live discussion going on. But basically what the due diligence is it's sort of, as a term, it's almost a mystified. Due diligence sounds DD, sounds like it's some magic words, but whenever you are buying something, you are required to understand what you are buying. And when you invest in a company, you're actually buying a piece of the company. However, instead of Emil selling me that piece of a company, it's actually the company itself selling. But in a same manner that when you are buying something and required to know what you do, due diligence is the same, that is what you are required to do as a buyer in order that you are careful about conducting the business. And of course, here is the difference if you think about as an angel or as a VC. As an angel, you invest in your own money. You can do as good or as bad due diligence as you want. It's your own money, feel free to lose it. But maybe one thing to highlight is that we did a study at FIBAN some years ago, how the time spent on due diligence correlates with the investment performance. And that the best returns came from angels who used 40 hours or more in due diligence. Per startup? Per investment. So if you used it on those that you didn't invest in, then it was even higher. Going above that didn't actually increase the performance. And funnily, 20 hours was sort of that what you shouldn't do, because 20 hours was worse than 10 hours or less. So apparently gut feeling takes you somewhere, then it goes downhill, and then you start to really understand the case. But meaning that the proper due diligence takes some amount of work. Then again, if you think about it, 20 hours, 40 hours, 1 week working time, and you're gonna put in 5K, which is probably more than 1 week's income anyway. So I think it goes hand in hand, what should be needed. But like I said, it's nothing more different than thinking about knowing what you buy. And now I hate you because you almost stole my slide. But if I go to buy a car, Geerts, will you sell me a car?
Sure, why not?
Okay, thanks, I take it. Now, of course I bought the right one, but I know you delivered this one. So obviously, if I buy a car, I would take it on a test drive. I would check how many kilometers it has. I would check the suspension. Actually, I don't know anything about cars, so there's a reason why I don't buy used cars. But this is the same that you should do with the startup. So kick the tires, take it on a test drive, and understand what it means. or what is good for. Hopefully, you see it the other way around, that first when you start looking into, it's the one with rust, but then you realize that, hey, the rust is only on the front. Actually, the engine is super good, everything inside is good, so actually this is more valuable than what it looks on the surface. And with startups, it can be either way. But what we look for in due diligence, you can basically break this into 3 areas, at least if I would be a Big Four consultant. Deal breakers, so a reason that we don't do this deal, red flag. Valuation adjustment, so something that affects the valuation or things to be fixed. Now, when I was working on Big Fours, like I said, over 300 due diligence under my belt, I still remember all of the deal breakers I found. It was 4. But in every project, we found that valuation adjustments. 1, it was later stage deal. There is always something you can haggle about. And secondly, if I don't find anything as a Big Four consultant and send the customer an invoice of 30,000, well, I will find something that they can adjust the valuation for more than 30,000. That's my business. But if you think about on startups, let's say that you are about to invest as a syndicate, 250,000 on a pre-money valuation of 1 million. Then you look into the accounts and see that, okay, tomorrow the company needs to pay back a loan of 500,000. Can you adjust the valuation for 500,000? No, well you can, but it doesn't mean you put in 250,000, it goes in a hole, the company doesn't survive. So in order to get over that hole, you should actually put in 750,000. And if you now start to invest 750,000 on a 500,000 valuation company, you're taking already a majority of that. So it's not a valuation adjustment, it ends up being a deal breaker. And this is the difference why this valuation adjustment really doesn't exist with startups. It can exist in the exit stage, on the later stage investors, but pretty much in startup world it's 2. Is it a deal breaker or is it something to be fixed? And like I mentioned, that it was about 1.3, 1.4% of the deals that I saw as a consultant that ended up in deal breakers. As an angel or as a VC, it's over 10%. And this is actually something that we did a research, not at FIBAM, but on the Finnish Venture Capital Association, that what is the rate between different VCs? And we found out that almost everybody has the due diligence failure rate of around 10. So usually 10 you are strict enough. If you go below that, then you're probably a bit too loose, you're not looking things. Then if it's over, then something is wrong in your initial screening process. So you are taking into due diligence cases that should have been killed earlier. It's no longer efficient. So, but meaning that the important things for us are deal breakers on one hand, and then something to be fixed. To be fixed meaning that, for example, it can be that the IPRs are not transferred to the company. Is this a deal breaker? Is this something to be fixed? I mean, if the founders are okay that, yeah, in connection to the funding round or before the funding round, we do the paperwork, we transfer everything, yeah, it's fixed. And that actually brings that the important part in due diligence is to separate between the 2 things. There is always something wrong with startups. If there's not, it's either not a startup or then it doesn't exist. But to understand the difference that, hey, here is a problem, here is an exposure, is it a deal breaker or is something to be fixed? Does it matter or does it not? And what matters, what doesn't matter, comes from why you are investing. So this is how I personally like to see the whole investment process. I know that there's different ways of building this thought, but how I see it is that first the screening part. So let's say I'm in TechGill, have that 200 companies there. I'm not going to meet all of the 200. First, I'm very briefly going to go through, does this fit to what I'm looking for? And of course, as a VC, I have somewhat strict investment criteria. I don't do life sciences, I don't do hardware, I don't do deep tech. So if I see that the company is doing hardware, I can skip it. If I see on the name of the company that there is nanomed or something like that, it already tells me life science pass. Or if I see that there is a piece of optics in the cover, pass. I don't even need read the name. So screening is very heavily about efficiency, so that then when you have those more interesting cases, you can use more time. And getting to the evaluation, so thinking about that, okay, on the face of it, this looks something interesting for me. But is it now something I should invest in? And starting to formulate the investment idea. Is this good investment for me? Why it would be a good investment? What kind of, and usually it helps that as an angel, if you have defined yourself something already, that these are the kind of cases I'm looking for. Maybe you have a background in certain industry, maybe your own know-how in certain areas helps. There are angels who invest in everything, but I would say that the ones who have specified that, hey, this is the vertical, this is the domain, it also helps them in finding the right kind of cases. It develops that you get the right kind of deal flow, but also since you can focus on those kind of cases, getting more of those kind of cases, it makes you better in evaluating that kind of cases as well. When I started my angel investing, I did the classic mistake of investing way too easily. I didn't have much of a deal flow. Most of my deal flow came from my customers. And if I look backwards, I would still today invest in the same ideas, maybe in the same teams, definitely not in the same terms. So that's one thing that the volume gave to me, but also the volume gave to me that I'm a lawyer by training. As I mentioned, I started my career at EY. As an entrepreneur, I started a competitor for EY. So I don't have any B2B SaaS tech background. But I would say that I'm relatively good as SaaS investor after looking for thousands of companies in that vertical, after investing in over 30 in that, now over 30 marketplaces, quite a few in EdTech. So it helps, the more you focus on something, it helps you on developing on the evaluation, what is strong, what is good, what is not. And here also maybe a tip, I understand that this is still for those early in the angel investing career, but I recommend also checking abroad, not only the local ecosystem, but what's going out there. So for instance, we had 1.5-2 weeks ago, a group of foreign investors visiting Latvia. Emil's kindly organized with Latban. And for many Finnish angels, it was eye-opening that what is the level of fintech here. And one of these guys actually was a fintech investor in Finland that pretty much said that, look, I'm never going to invest in Finnish fintechs again. In fact, being that just the ecosystem here is more developed than in Finland. And if you look only on your own ecosystem, you can be easily in a bubble and not seeing these kind of things. But so sort of the outcome of the evaluation is that you should formulate whether you call it investment idea, investment thesis, but the reason why this is a strong case. And then when we move to due diligence, you need to start disagreeing with yourself. For me, it goes easily. I usually disagree with myself even mid-sentence. But basically ask the other way around that, why this is not a good investment. And especially going through the framework that why I think I want to invest in that, starting to double check, challenge those elements. Some areas that you look on due diligence, first of all, this is not exhaustive, and secondly, you don't need to look all of this. So like I said, depending on your investment idea, that should give you the baseline of what is important, what is not. So for instance, let's take team. You are really convinced, especially I think team is when you are in the early stage, that is the only item that should be always on the list. On a pre-seed, there is not much. You're betting on the team, maybe betting on the market. If you are betting in the product, it's going to be a different product anyway after 2 years. But if you think about if the team is their reason to invest, then okay, what is it in the team? Is it their expertise? Let's say it's a deep tech case. The guys claim that they have the best research out there. All right, what is their publications? What is their scientific track record? Are they really the best researchers? We're going to go through actually one case example, and then I'm going to dive a bit deeper. But if you look then more, for example, a case that doesn't necessarily have the kind of moat through IPR that a deep tech case has, then maybe it's a more of an execution play. Then you want to understand that is this the team capable of executing? And if you think about when the due diligence starts, like I said on the beginning, that there is a screening, there is evaluation, there is due diligence, it's not actually this black and white. I mean, sometimes in screening you already do due diligence, sometimes in evaluation, sometimes you decide to leave something intentionally on due diligence phase. But I would say that the team due diligence starts on the very first meeting. That's the first time you talk with the founder. That's the first time when you have the bit of get the feeling, how they are thinking, how they are working. And I get often asked how to do team due diligence. I mean, pretty much on everything else you can give a checklist. On team, not really. And I can share my own process, and I would love that everything I do would be quantifiable. And on team, I'm not there yet. So I start with the ones that are quantifiable. I look at their track record, what they have done before. I might talk with their former employees, I might talk with their former colleagues, customers, whichever is relevant for the reason. So if I, for example, want to understand their understanding of this business, probably I can talk with their former colleagues, former customers. If I want to understand their execution skills, what they have achieved. I mean, we are in a bank, so then I need to say this out loud. Past performance doesn't indicate future profits. But generally speaking, if you have performed, if you have executed in the past, you continue executing in the future, or at least vice versa. If you have never delivered anything, you are not in one night going to be turning into somebody who is super capable of delivering things. So that's sort of the maybe more quantifiable. Emils.
Have you tried doing personality tests on founders?
Yes, and don't do it again. And that actually comes to the other side, and just like, which is not quantifiable, but I think I didn't ask your backgrounds, but I learned that most of the business angels do have, surprisingly, they have backgrounds in business. So you have either running your own business or being in a management position in some business. So you already know how to build a team. You have been doing that. And that's what I'm looking when I'm talking with the founders, that basically the question is that would I consider this as the most senior hire I would ever make? Because in the end of the day, when you make that investment, that's a journey like a marriage. Actually, I was lying. In Finland, average marriage takes 5.5 years, and average startup investments takes 8.5. So it takes longer than average marriage. And it is at least as intensive, I can tell you that. So, but for instance, already in the first meeting, I start on one end answer to this question, that would this be the kind of person I would hire? And secondly, is this the kind of person I want to work for the next 10 years? Up to the moment that I can exit from the company. And at least it gives something, and then I know that yes, there is a high risk that I'm more likely than not hiring somebody like myself. Luckily for me, that somebody like myself would never start a startup because they are too scared of things going wrong. So I made up investing in somebody like my co-founder, who then again runs out of money in 4 months if they don't team up with somebody like me. So that's the risk, that when you start to look at it from that angle. But that, I think, is one strength of angels investing in a group, is that you are not biased with only one person's view, but you can actually build around with, I mean, one person can be wrong, but if several persons are looking and seeing the same things, there is a reason why there's a pattern. It can still be wrong, but at least the probability should be softer. But on the question of personality tests, FIBAN has been sold this quite a lot. Quite a many companies want to do our members portfolio companies. Every now and then we have tested. And that the problem usually with those is that if it supports your own feeling, then you're happy with that. If it contradicts, then you think that the test is shit. And you know the results usually only after 5 to 10 years, so by the time I cannot go back to the test service provider and say that, hey, I want my money back, you were wrong 10 years ago. But yeah, team really in the core of the due diligence for angels, no matter which stage you are. Then on the other items, product, depending once again, it might be idea states. I don't do idea states, so I don't comment that too much, but it might be that the MVP is just out there or there's very early results. I think in the MVP stage, I would still be looking at, okay, how this product is different from what else is out there, to understand that is there a differentiating factor, and also understand about building the product that is there a moat, is there something that others cannot do, which usually is the reason why people do deep tech investments, that you have put years and years of research and you are ahead of anybody else, then you can do it. If you are going to a later stage, this product is already on the market, then it becomes easier. You can start looking into that. Is there problem-solution fit? Does the product answer to the customer's problems? And that doesn't mean that there needs to be sales. If there's sales, it's easier. But already you can start talking with potential customers, explain the problem, explain the solution, see the result. And one thing I would like to do here is actually being that see how the founders are selling. So at the same time, I'm actually testing the team and testing the product. So might be that I see a potential customer, I go to the team that, hey, actually, do you mind if I give an intro to a potential customer? I would like to get their view of the product, and of course you can pitch. And 99% of the founders, they would jump on this idea because, hey, there's an interesting customer coming up. And on a best case scenario, the customer verifies, they are buying, and the founders love you, and you can invest on a good terms. On a worst case scenario, you find out that there's not a market, and you save money. Very, very useful tool if the product is on the stage that it can be presented, but also valuable for the angel investors to understand that if you have that kind of broad network that can be potential customers, this is already one way that you can show your value to the founders, even before you are investing. And one thing is that we are competing with the most lucrative deals. So the more valuable you can make yourself, the more likely you are getting into those good deals. Market goes pretty much hand in hand with product. I would say that on market, I would look for a couple of things. So first of all, starting with what kind of returns I want to make. Is the market big enough? Usually as an angel, if you put in a small ticket and the company doesn't need a follow-on funding rounds, there is no too small market. I told this, and then I ended up investing in a company that captured 100% of their total addressable market. That was 3 customers. So yes, there can be 2 small markets in the end of the day, but I sort of thought that their product would work outside Finland. It didn't. And that they got, unfortunately, luckily they got all the potential 3 customers in Finland. Unfortunately, nobody wanted to buy a company of that size, but we wind it down and distributed the dividends, and I got some money back out of that, but not gonna be on my trophy cabinet. But yeah, especially on VCs, it starts to be that the market really needs to be big enough. I mean, at Rind, we have 55 million fund. On the best companies in the portfolio, I want to be able to put 5 million in, and I want that they will bring 50 million back to me in a best case scenario. And if I own maybe 20% at the time of the exit, that means that the company needs to be exited at 250 million valuation. It already means that, okay, you need to have, depending on the business once again, but probably you need to have a business where the revenue market big enough that company with can be arena revenues of hundreds of millions. There are plenty of businesses like that, but not everything. But as said, as an angel, it doesn't necessarily matter. So that's one of the questions that when you formulate the investment, scope investment thesis that is a market thing for me or not. Competition going hand in hand with the market, especially with early stage, understanding that, hey, who we are competing against, and Geertz is going to go through a pitch deck, and I'm waiting to see the competition slide, but I'm usually guessing that there is no competition. That's slide number 1. Or slide number 2 is that there's competition, which is here, here, and here, and we are there. We are so much better and so much better. And I love that founders think like this, but the fact is that there's always competition. I mean, you can use CRM or you can use Excel. Excel is a competitor for CRM. Even Notebook is a competitor for CRM. So there is always some kind of competition. Only exception is that if something is not worth doing. So whenever I hear that founders say that nobody else is doing this, nobody else is solving this problem, my first question usually for them is that, are you trying to do something impossible, or do you not know how to use Google? Usually after that they find the competitors. IPRs, especially in the early stage deep tech cases, might be that IPRs are in the core of the reason to invest. Might be also that you are in a pre-product situation. Then diving into that in due diligence. So looking, for example, that is it patented or not already? If not, what kind of, have they done any freedom to operate? Have they done any analysis on the patentability? If they have, how broad the patents can be, how good protection there can be, and if it's in such an early case that you cannot do this, then understanding that what other research goes on out there. So here you can see that already if you're investing in a deep tech product, understanding the IPR side, the due diligence is very different if you're investing in B2B SaaS, where it's between the market, product, and team. And of course, in a due diligence, it doesn't make sense that you use equal amount of time. Same goes with regulation. If you do a fintech, important. Life sciences, super important. B2B SaaS, well, technically, probably you want to check the GDPR box just so that you can say that it's been checked, but not that much regulation things going on. Financial, that I would actually divide into 2. So maybe first on the startup due diligence side, understanding that how the business looks going forward. So what kind of unit economics you can expect, what kind of metrics it looks. So for instance, like even if the product is not out on the market, we can already guess that if it's a B2B SaaS, there are some similar solutions out there, or even if not, we know the value of the problem. So we can guess that what on average the customers typically pay on that kind of product. And similarly, you can pretty much tell the customer acquisition cost based on what kind of solution there is. So for instance, if I see any dating app where the customer acquisition cost is over $10, I'm not investing. It doesn't work out. And we have invested in one dating app, but I probably rejected 80 of them. I know those numbers still by heart. But the important aspect for an early investor is also to understand how the financials are behaving. So what is the need for future financing? Do you want to be in a situation that you invest, company becomes cash flow profitable, and then based on that it can go to an exit, it can maybe distribute dividends, or maybe it decides to take additional funding but takes it on its own terms? Or are you going to invest in a company that it's, yeah, we're going to burn this money in 12 months and we're going to go that there's going to be a pre-seed investor, and you take the kind of pre-seed investors who are going to say that, okay, that's nice, by seed round you need to be 5 times bigger, so take a huge risk, burn out all money in 12 months. And then by the Series A, it's Andres and Horowitz on the table, they invest 200 million. And of course, all of these rounds have come with liquidation preference. And those who don't know, I thought that liquidation preference is further on the agenda. Liquidation preference means that if I have one times non-participating liquidation preference as an investor, when exit comes, I can decide whether I take my money back or whether I take based on my ownership. And when these all round stack, the liquidation preferences stack one top of each other, you have Andreessen Horowitz with 200 million getting their money first, then you have the seed investor, pre-seed investor, and then you have the early angel. So maybe all in all, 250. And then you realize that this hottest of hot metaverse startup you invested in 5 years ago, it's not making any money, it's running out of cash, and the metaverse bubble has burst. So Andreessen and founders realized that, hey, let's sell this seed to Netflix and recover what we can. So with that, even if it looks good on paper, multiples are nice, you end up in a situation that you lose half of your money just because there is nothing coming out. And by the way, this wasn't a hypothetical example. This is a true story. I mean, it's a good journey to embark, but then you need to understand what it means. And usually as an angel, you cannot protect your position. One thing that you can avoid on this kind of situation is to follow on each investment round, and then you have the same rights as the latest investor. But the problems usually are that at one point you can't. If it's 200 million round, it's nice to be able to follow that as an angel, but usually you need a bigger pocket than I do. So at sometimes you run into that doesn't work, and that's sort of when investing in a company, asking the question that what is the funding track for this company? What is expected? What will be needed? And from that understanding that, is this the kind of journey I want to be involved or not? And secondly, I would say that that's an important discussion to have with the team during the investment, and with all of the investors, because quite often it happens that founders want one track, investors want another track, or even part of the investors want track A and part track B. And then we are in a situation that we have all shareholders in a company, and we have very different expectations how to proceed it forward. So aligning all of the stakeholders' expectations, founders, new investors, and also especially many founders don't understand what it really means that you enter that VC track. You sort of maybe think that, okay, I raised that one funding round, but it doesn't really work like that. So for instance, in our fund, our first ticket is always a fraction. As a default option, we are expecting for the second round already. And whoever leads that round is usually once again expecting the next round. So there's a reason why is this separate VC track. I mean, if you drop out of the track, it doesn't mean it's a bad company. It just means that it goes on a different kind of trajectory. It's looking for profitability earlier, and are probably giving up some of the growth, but also they are giving up a lot of the risk. The other side on financial to look into is this boring old financial due diligence. So as I said in the intro, you want to know if there is a $500,000 hole in the books. So yes, looking through the accounts, looking through balance sheet, profit and loss. Depending on the country, sometimes even actual accounts. I remember one case that we were existing investors in the company. There was follow-on round coming. There was external lead investor. Still as internal existing investors, we hired PwC to do a due diligence and looked at, has the company really gotten the money they are saying? Two reasons: they were operating in super exotic countries, so we are talking about Southeast Asia, we're talking about Latin America. But the main reason was that it was just doing too well. We couldn't believe it. And luckily PwC agreed with us, didn't agree with us, they agreed with the numbers that, hey, yeah, it's too good to be true, but it is true. So we did invest on follow-on, and after that the journey has been like that, so it's nice to be in some of those. But I would say that actually surprisingly often, if the company has a bit more history, there is usually something hidden in the books as well. If it's a new company, then usually not, but already like thinking about the due diligence, that's maybe the first one of the things to note that, hey, was this company established just now, or does this have a longer history? The longer history, then you can expect more work to be done on the due diligence front. But then the key question, which one these matter, which one don't? Which are red flags, which are yellow? And it comes, what was your investment idea? What was the reason to invest? So that's why I want to go back, that if you decided that I'm investing because of the team, spend time on the team. If you decided that I'm investing because of the IPRs, because the disruptive things that they are doing. Look on the IPRs, looking on the competition, spend the time on there. At that moment, it doesn't make sense to use too much time on the market size, for example. Of course, like always, depending on what it requires for the company to succeed, what it requires for your investment idea to come true. But I know this is super abstract, so I'm gonna put it on a bit concrete. So we're gonna walk through now one actual due diligence, which of course like it took maybe 3 weeks. By the way, those who don't know, due diligence is Latin meaning that the 3-week hangover without the preceding fun. At least that was the feeling when you were doing those for work. But we invested early last year in Barn Express. And I'm looking at the date, it cannot be correct. There wasn't February 29th last year as I'm checking, but so what the company does is that it's a platform that connects drivers, car marketplaces, and the dealerships. So for instance, when a Finnish car dealership needs new used cars, it's not getting those from customers, it's actually buying those from Germany. And when the car is in Germany, it should be sold in Finland, somebody needs to transport that. Traditional way is that you wait until you have 8 cars, then you put those in a truck, then you drive that truck. But the thing is that every day the car sits, a dealership is losing about 50 euros. And to get 8 cars to fill the truck takes some time. So what these guys figured out that why we don't take some students, buy them flight tickets and say that, hey, you want to drive this BMW from Germany to Finland. I can tell you that building that side of the business has not been difficult. There's plenty of voluntary drivers. But when we invested in this, it was pretty much on an idea level. They had some early customers, but on the product side, well, we couldn't do product DD because the product at that moment was their whole tech stack, a WhatsApp and a Google Sheet. Everything was done manually. But what was nice about that was that they had been actually able to already with that test that does the market work or not. But if you look at how we formulated our investment idea and then the due diligence here, what does it take for this kind of platform to succeed? The thing is, more you have drivers, the more you have dealerships buying, the more you have supply, the more efficiently you can organize these routes. So instead of you fly a driver from Helsinki to Frankfurt, then they drive a car to Tampere and take a train back to Helsinki. How about they take a ferry to Stockholm, drive one car to Netherlands, then take a train to Frankfurt and bring that other car back. A lot more efficient. And so more volume can get, you actually reach that point that the economies of scale and networking effects mean that if you're the first one to do it, it's very difficult for competitions to match your production cost. You can outprice your competition. So that was one of our investment ideas, that this has to be possible. And it led to the question that, is this even doable? And how much money does it take? Well, is it doable? We basically went through that how many transactions are and can you pull this? So we ended up going through that how the, a lack of better words, I'm using the word car flows in Europe go. And it goes roughly that the new cars come from Germany. Then they go to Netherlands and back to Germany. They take a U-turn there. Then you sell those to Nordics. From Nordics, you sell those CEE, Poland, Czech Republic, and then from these countries it goes to Southern Europe and then to Africa. And it looks like, okay, it actually goes like this. And now the problem is that this is a bit one way. It doesn't really work. But then we figured out that actually if you add the intra-country deliveries on the mix, then you can get more efficient drives out of that. And the volumes, definitely big enough. We come back to this later. Problem solution fit I already mentioned earlier. So for us it looked like that on the face of it, yeah, it makes sense. It's faster. The dealerships are gonna make more money. So yeah, should be. But to be honest, I already said that I'm not a car guy, so I don't know anything about buying and selling cars. I don't know if it is a problem or dealerships. So we asked the team to provide us with some contacts. Then we called to our own contacts, and is this a problem or not? Those calls gave us an indication that, yeah, this is a problem. Then we tested. So we asked the guys to meet one of our contacts, and then we actually asked them to one of our portfolio company, which wasn't announced at that time yet, so they didn't know that it was our portfolio company. We asked them as a potential customer to call in. Well, both of these calls led to closing of a deal, and so okay, it seems to be. And another thing that we were able to see that when we looked at the past purchases, we were seeing that first you do one transaction, but then they started to increase. So meaning that the customers are also happy with the service. They come back and they come back for more. And of course, nice thing about transactional business that you can do it like that. You can test something. It's very different with CRM. I don't know how you test CRM because you need to, you don't want to run 2 CRMs. We had the 2 CRMs for 2 days, and that was way too long. Half of the people entering information in the wrong system. Execution game. So really coming to the first of all the team capabilities, and here we had a bit of benefit. We knew this team already, so they had pitched their previous startup to us, and I had coached their previous startup in one accelerator, and back then I already noted that, hey, this is a team that I should follow. It can deliver, but the idea that they are working with. I told them that there's 4 reasons why this is gonna fail. And actually how this came to our table was that I said, oh, Matthias calling. Hey, how you doing? Yeah, you remember when 9 months ago you said that we're gonna fail. I'm like, okay, now you're gonna tell me that you raised an A round of about 1 billion valuation. So we decided to shut down that company. We have a new idea. Do you want to take a look? And I got the deck and I was first like, is this even a business? I have never heard about transporting cars cross-border. But apparently it was. But also on the execution game that comes that hand in hand, that what is the competition? Is there well-funded competitors? And there's actually quite a few well-funded competitors, but for some reason that we missed in the due diligence, you always miss something, we found that all of the competitors were focused on the intra-country deliveries, not cross-border. Of course, it caused us a bit question why, but we sort of brushed the force that, okay, in cross-border, the competition is the trucks, is the established way of doing business, and nobody has just figured out a better way until now. What we learned now, being a year and a half as an investor in that company, cross-border is super complex. So when I said that the moat would be economies of scale and networking effects, I can now tell that the moat is to understand what kind of legal regulatory requirements you can have in different countries. So for instance, if you want to drive that car from Germany to Finland, you cannot use the normal registry plate, you need to take a red one. But the thing is that they don't give you more than one red plate on the first year because they don't trust you. You need to show that you're reliable. Then after 2 years, you can get 3 plates, and 3 years, 5. And these guys were planning to move thousands of cars a month. But that got solved, good team. But yeah, the teams that we knew the team and also their track record, like I asked in the due diligence how you guys know each other. From the military. Okay, where did you go to? Yeah, we were in paratroopers. Well, in Finland, in paratroopers, it's about 5% acceptance rate. You already know that guys have to be really tough. And then we chatted a bit more what you do as a hobby. Yeah, we run. Oh, nice, faster distances. So I'm running marathons myself. Yeah, bit longer. Longer than marathons. Yeah, we are ultra runners. All 3 founders. On the previous weekend, they had run 160 kilometers in one go. But if I think about we have a lot of athletes in our portfolio, and one thing is that as an athlete, you train a lot for a goal that is very far away, and you train every day, you stick to a program, or then you just take it as a hobby. But on an ultra runner, it's still even on a different level, but that sort of tells me that this is the kind of personality who understands what it means that your goal is far away, but you stick to that and you work every day to get to that. Plus, on the ultra running, they know how to suffer, which is always good quality for a startup founder. I think it's good quality for every entrepreneur. And then finally for us was the venture scale market. And as I said, like I didn't know when I saw the cover of the deck and first pitch like transporting cars. This is not a business, this is a hobby. There cannot be a market on this. And then the second that, okay, let's look at the market size. If you Google what is the size of the transportation of second-hand used cars between dealerships cross-border in Europe, guess how many hits you're gonna get? 0. So of course there is no number on this. So we needed to think about how we figure out that market. And luckily EU is EU. We have stats about everything. And apparently on the European customs statistics, you were able to find not only how many cars have been moved across countries, but between which countries and which have been moved by private individuals and which have been moved by businesses. So businesses, we can extrapolate that most of that, not all, but most of that is between dealerships. And I was expecting that without knowing that this is something of a, maybe on a sunny day, hundreds of millions in Europe, not venture scale. Then we figured out that it's probably 5 billion, definitely venture scale. And today I correct my number, I will now put it on 12 billion. So definitely venture scale. But this is how it formulated from our original idea, checking. But if you look at that, we didn't dive into too much of the IPRs. It doesn't matter. We didn't dive into their tech because there wasn't any. We did dive into that, can this team build one? So for instance, the CTO was something that we looked on his background, what we have been building. We talked with his former boss. One startup that we have passed, by the way, in the past. So it was when you pass a company, pass it in a way that you can call the CTO anyway later. And we ended up doing the deal. Before I open the questions, one thing I want to say that, of course, now I'm doing this as a VC. I can do this full time. And I'm not doing this alone. I have a team. And as an angel, you're a bit in a different position. I mean, it's limited amount of time available. But I think two strengths that you have is that, first of all, there's a group. You don't need to do it alone. And secondly, I like that what Latban has been doing on this syndication, that especially you can at the same time build on the know-how of the team, but if you think about financial DD, legal DD, regulatory, something that is repeating, there's actually professional people doing that, and it works for all of you. Like we as a VC, we can use, and we do use sometimes external consultants. If we do a deal in Finland or Estonia, probably not. If we're gonna do something in Spain, yeah, we're gonna use a Spanish lawyer. I can read Spanish, but I have no understanding of Spanish law. But then again, our ticket is maybe 500,000 or 1 million. I can take that 20,000 invoice, not a problem. If the round size is 200,000, you don't want necessarily put all of that into advisor fees. But I really like the concept what Latban has been doing with this syndicate, so help to build the due diligence and perform it professionally. But having said that, I always need to end with the caveat that when you're investing, it's your own decision. So if you don't trust on somebody else's due diligence, know who you're trusting. Don't end up like one deal which me and 2 other angels did that. One day we are on a dinner with the founders talking about how we ended the deal, and Kim says that I was following Reimo. I'm saying I was following Ari, and Ari says that I was following Kim. And we figured out that actually nobody had done any due diligence. But things happen. We didn't get our money back on that one. But now we have 3 minutes to questions, more or less. Yes.
Yeah, so you mentioned that the teams is pretty much the key. So how would you approach to understand that the team, one or more people, are super professional con artists?
I think I have fallen into that at least once to start with. But no, it's like I said, first looking in the track record. So I mean, you can fool some people all the time and all the people sometime, but you don't. It's very difficult to fool all the people all the time. So usually in the track record it starts to show. That's maybe one thing, but also like getting a broad overview. So what I can understand from the people who have worked with that. But yeah, that's always a risk. And luckily, I would say that in the startup ecosystem, there are more real founders than fraudsters. And luckily, anyway, there's 50% chance of losing the money, so it doesn't really move the needle too much. You decide.
There are pretty much quite a lot of questions with similar patterns that you need to run through due diligence. Do you have tools that you use? Yeah, kind of. I mean,
We do have checklists, especially on financial or legal, because that's sort of like you want to go through the processes. But on other areas, it's more goes that what, like I said, from the investment idea, what is important, what is not. And I mean, I personally don't like to use these kind of check the box lists because that easily drives you that you use too much time on something that doesn't really matter, and then you make, okay, it's a good team, when that might be.
what I meant is, I mean, you need to check financials.
Yeah.
Obviously, you can run something there and get it anyways, even if you are not particularly looking at financials for that stuff.
Yeah, but I mean, on like I said, on financial due diligence and legal due diligence, there I do utilize a checklist. And once again, after 300 due diligences, I don't need that checklist. I remember it still by heart. I still remember that on line 23 there's a typo that I haven't fixed.
I was just wondering about that the market size on this particular example, but maybe you can generalize it. Like you said that there's statistics for everything, but statistics only shows you the past and the present. And how do you know how big the market could be in the future?
Actually, excellent question. And I use statistics as an example in this particular case because I needed a starting point. But that's one thing that I sort of goes more, in my view, maybe on the investment idea evaluation, the case evaluation, that sort of what's the investment horizon? It's probably like 10 years. So what the market is like in 10 years. And you are not wanting that the market is peaking in 10 years. You want that the market is going up in that moment. And if somebody figures out the tools that I can see 10 years in the future, I will buy those immediately. But of course, a couple of things that you can build on. What are mega trends? So for instance, we do know that there's an aging population. So on that, we can already draw some conclusions about consumer behavior. But if I would ask the same question today and 3 years ago from every SaaS investor in Europe, everybody today would admit that they didn't see coming what is now happening with AI. Everybody is going through their portfolios. There's a lot of companies which it doesn't affect the value at all, some that benefit and some that are totally wiped out, even though they are still existing. I think this is also the beauty of this sport, that you are forced to look into future. But some things never change. A friend of mine is a food tech investor, and he said that, yeah, my reason to be a food tech investor is that I don't want to predict future, but people will eat. There's always need for food.
Maybe I have a little bit outside the scope of question regarding if any of the companies you've invested have been led to IPO ultimately.
A few. I have to put caveats. IPO isn't necessarily not a good exit. It's especially if you IPO in Nordics or Europe generally. In US, but it also varies. But yeah.
I guess the US is the holy grail for IPOs.
Yeah, but even, I mean, if you have do you do an acquisition by Microsoft or Google, or do you IPO? I mean, in US you can IPO pre-revenue companies, so it doesn't mean it can be. I mean, if you look at some of the US IPOs, you see 5 million valuations. And at the same time, you cannot see a pre-seed in the US on 5 million.
There's a strange correlation with the market size, right? Because when you do an IPO, actually the market size becomes less relevant because the market size is anybody who can invest.
No, but in the end of the day, for somebody to invest, somehow they should make money. And usually it's either that your own business can grow, or then that for one reason or another you are an attractive acquisition target. So for instance, like I have been involved in one exit or several exits, but one that comes to my mind, that we had several offers on the table where most were, they looked on our EBITDA or revenue and gave a multiple on that. And then one buyer thought that if we would sell this to our own customers, we could make this much. And if we don't buy this and they start competing against, we can lose this much. So they actually priced us on multiples on their own business. And surprisingly, there's a huge gap. They were by far the best offer on the table. But there's always needs to be a reason why it happens. So I've seen maybe too many of these that, hey, we raise money, we build a product, we raise more, we IPO in US and profit. And it maybe reminds me too much of some old cartoons where you see elves are taking pants, blank, money. And that blank is quite often missing.
But the Nordics IPO market still is growing, I guess, in the last...
It's growing, but like it's really, I mean, this was a major portfolio. My last IPO in the Nordics was maybe 20 million valuation. So I would not consider that as, I mean, it was good exit on that company and good path for that company. They are profitable and so on, but it never was a VC case to start with. It was nice angel case. I got my money back, but that's a good thing as an angel. I mean, you can go in with small tickets and low valuation. As a VC, if I need to return my fund, it doesn't really help that I can get in low valuation, because on low valuation I cannot take 90% of the company. Well, I can, but there's no entrepreneur anymore. I would need to run it, and I've done my fair share of being an entrepreneur. I'm done.
Okay, thank you.
Actually, I had a question. In the slide where you showed the things that you like do due diligence on, the one thing that I didn't see is like the current traction progress of the startup. Like, for example, I don't know, if they report already 500 yearly revenue, how do you approach it? How do you check it? And do you have like any red flags when misinterpreted?
Yeah, I would put it, so first of all, I would put that maybe under the financial side. But yeah, it's I would say that 90% of the decks I get are looking at the metrics there. When I start to looking into those metrics, those are not correct. So, it's not that the founders are misleading, it's just that they are counting differently. Customer acquisition cost is one of my favorite numbers, because there seems to be as many ways to count that as there are founders. But quite often in the due diligence, we first dive into that, how you have counted that, how you have calculated that already, like how it is in the materials. You start to get the understanding. Do they need to start compiling it, or does it come directly from the system? If yes, what system? Does the information flow directly from Stripe or some other payment, or is it manually entered? I mean, in some cases we have even asked that, hey, provide us the accounting statements if the numbers don't seem to add up. But ideally, when you end up in that situation that you need to ask that kind of questions, it's already that, do you trust the team enough to invest? I mean, there's plenty of other cases. It's easy to walk away. But another thing that I would like to mention relating to metrics is that it's a tool for me, basically evaluating many of these. So if you think about, for example, product market fit, does the product work? That is reflected in some of the numbers. That is reflected on how quickly the team can sell, on what price point they can sell. But then if you think about if the market works, we can see that how the users are using the product. Are they renewing? Are they increasing their usage? Or are they churning away? And if I would need to put one number to determine if the company has a product market fit or not, I would look at retention. And similarly, like if I look at what is the team's track record, if they have grown the business by 1 million and at the same time burning 500,000, that tells me that the team can execute. And then if I see that, hey, they grown the company by the same 1 million, but burned 10 million, that's sort of that, yeah, this does not look too good. So, and that's the thing that like looking at this bit more hard data, you can also evaluate this bit more softer aspects.
Any more questions?
Maybe one more.
Shoot. And I will be here during the networking, so if somebody wants one-on-ones, that will work too.
What's your take on the ESG side of things, and what are generally VCs? Are they looking towards this side or not?
You are happen to ask on the week that we are finalizing our ESG reporting. So that's sort of, yeah, it's, I mean, I understand why it's done, and in generally, I think it can be a very good tool for many of the companies. However, I don't like the way it's done today, which pushes that, like SAB, you want that you put the loan or the equity investment into a fund, you want to put that on Article 8 product. So you want us to be Article 8. And then we need that our companies, we operate in a manner that we can comply with that Article 8. If you don't know what this is, it's just a one ESG classification of one instrument. But how it is in practice is that there's a tons of compliance. So literally, I have the European Investment Fund template, and now I remember the number because I just told my team it this morning. There's 302 fields for each company. Going, for example, that do they have a human rights policy? And not that do they follow human rights, that's a separate question, but do you have a policy? Tick the box. Do you have an environmental policy? Do you have a code of conduct? Do you have an equal opportunity policy? Do you have a responsible AI policy? But then going to items like what's your employee turnover, to be honest, it's a useful number for us, so employee turnover, how many has left the company. If there's a lot of turnover, it tells us that, hey, maybe we need to understand at least where it comes from. Then again, if you think about green bonds, if the idea is that we push money towards renewing the economy that is more sustainable, you need to measure the environmental impact, you need to measure the emissions. But now after collecting this information from all of our portfolio companies, 90% of the information is such that it is reported. Does it add value? No. So I'm a bit like, I mean, I'm for it despite my negative comment, but I'm not for the way it's currently being done. It pushes too much of this check the box, and then at the same time, what it does not do is that if the companies actually have positive impact, that is not measured. So instead, you're asking that, hey, how much electricity you are using on your office, and not asking that, hey, by the way, since you're replacing combustion engines with electric engines, how much you're cutting emissions. So I would say that the focus is too much on the footprint and not enough on the handprint. But it is what it is. At least it's now standardized all over Europe. We did this reporting so that we had different ways of reporting to European Investment Fund, to Lithuanian, Estonian pension companies, and Finnish investment companies. So now we at least have one format for all. So EVA is 300 rows. Those are now same 302.
Sell it as a service.
Sorry?
Sell it as a service.
As a VC, we can't. I mean, we get our money from our investors, not from the startups. We get it from the startups at the time of the exit, yes, but and there's too many service companies providing that already. I'm not going to start competing in that market. Doesn't pass my competition due diligence, sorry.
All right, thank you.
Thanks.